The impact on the ready-made garment industry is going to be effectively a squeeze on their margins, right? Their margins will be under pressure. Whether it's because of new capital equipment they're buying, or if it's because they now have to buy more expensive raw materials, or if they have to buy technology for tracing the origin of their raw materials, or if they have to pay increased wages, or if they have to provide safer working conditions. All of these things which contribute to the production of more sustainable products are costly and will increase the production costs that the RMG industry is exposed to. So what are they going to do? Well, one of the first places companies turn to is their financing cost. They can't pay higher interest if their margins are already squeezed. They will need or they will request for lower cost financing. Now, if we think about an FI or a bank, unfortunately, in some ways, they're really agnostic to the underlying use of the money that borrowers receive from loans that the FI makes, right? A bank, yes, banks and FIs, of course, evaluate the risk of a borrower and will make accommodations or pricing decisions based on the risk of the borrower. But fundamentally, if a lender is lending into a coal-related industry, a coal miner or energy producer that uses coal, or if they're lending to someone that grows spinach organically, fundamentally, very basically, and I don't mean to oversimplify things too much because obviously there's some details that I'm glancing over, but at the end of the day, the bank's funding cost is the same. The funding cost doesn't adjust for if something that they're lending to is more sustainable than something else, right? The funding cost is still the same. At this point, that may change down the road when central banks make capital reserve adjustments for less sustainable uses, but at the moment we can say that banks and FIs are agnostic in terms of pricing to what the underlying use of proceeds from a loan they make is, right? But there are some things that an FIs could be doing to lower their funding cost, especially if they're making loans with sustainability in mind. And what I mean by that is, over the last several years, particularly since Paris Agreement and then escalating very quickly over the last 5 years, governments, countries have been encouraging or requiring their respective countries and their systems to implement procedures and processes to encourage companies, banks, people, energy producers within their countries to become more sustainable or adopt more sustainable practices, right? And that has even gone to the extent where governments recognize that banks and FIs have this inherently they're agnostic. So there's no reason why a bank would want to lend to a sustainable project more than an unsustainable one, other than reputation at this point, right? So countries and governments have recognized that, and they have set up some vehicles to try and help banks. And big picture, we call that blended finance. So in order to encourage banks and other mainstream lenders to get involved in more sustainable projects that might be a bit expensive or come at low margins or have a bit more risk or really aren't any different in terms of return than a more mainstream project, in order to encourage banks to get involved, governments have set up funds in some cases, right? So specialized funds. So they've contributed capital into funds, and the funds will deploy money towards certain things that are deemed sustainable. All right, that was a lot of talking, a lot of narrative about something that I'm actually quite passionate about. But at the end of the day, what I mean to say is that if there's an underlying purpose for a loan that is sustainably related, there can be options for banks to get lower cost funding. And if we take that one step further, we know that all this retooling or these changes that the RMG sector in Bangladesh is making and is going to have to make to continue to sell into the EU, those changes are sustainability related. So if there's financing that's going towards helping the RMG industry become more sustainable, there may be options to find lower cost funding. And one of the ways that FIs can try to comply or provide lower cost funding or obtain lower cost funding is by working with a multilateral development bank or developmental financial institution. People like the ADB, the IDB, the AIIB, IFC, Proparco, on and on and on. All of these DFIs and MDBs have a mutual agreement that they will focus on climate, right? And that includes how much money they've allocated towards it. And another thing about MDBs and DFIs that not everybody knows is that they are actually, they manage funds, right? So specific funds have been set up by countries. Let's say it could be a fund that's purposed to invest in green finance, right? So MDBs have access to these funds, this fund's money. And while MDBs or multilateral development banks are not, while they have a mandate to not disrupt the commercial market, what that means is that they are encouraged to lend at commercial rates. While they have that mandate, they also have access to specific funds that come at a lower cost, that if deployed, if it's verified that they're deployed into sustainable things, then those funds can be blended with MDB's other money, and at the end result is that it's a lower cost loan for a borrowing FI or borrowing bank than if no fund money or concessionary fund money. But basically, it's worthwhile for this specific purpose of helping RMGs get to a point where they can become more sustainable so that they can continue to sell into places like the EU, which are implementing sustainability regulations. There's a very strong chance that there's a pool of money available to banks or FIs in Bangladesh that are lending into that RMG sector that may, under certain conditions, come at a lower cost than mainstream lending from the MDBs. One example of that is the Green Climate Fund. There's actually one of the infrastructure lenders in Bangladesh actually manages some green climate funds. But GCF was established by 194 governments to limit or reduce greenhouse gas emissions in developing countries and to help vulnerable societies adapt to the unavoidable impacts of climate change. Now, if you think about that, many of the retooling requirements that the RMG sector will have to undergo so that they can continue to sell into the EU under EU Green Deal directives are related to reducing greenhouse gas emissions, right? They have to become more energy efficient, they have to do more recycling, they have to make sure that they're sourcing from appropriate suppliers. All of those things arguably, or many of those things, will contribute towards lower greenhouse gas emissions. So GCF is set up to provide money or invest in exactly those purposes. There are certain conditions that are not difficult but must be met, and a lot of that has to do with verifying and obtaining assurance that the money that was received under the loan is actually being applied to the purpose that, in this case, the GCF had intended to fund, right? So when you make a loan, to an RMG industry and into the RMG industry, and the RMG industry says he's going to use $10 million towards new machinery, $1 million for an ETP, all that stuff, then there will be verifications along the way. So how is it verified? Well, the bank has to complete forms and demonstrate that they have measured the impact of the loan, and that means things like before new machinery was purchased, what were the GHG emissions, and then after the machinery has been implemented, what are the GHG emissions going to be, and then what are they actually 1 year down the road after the company has acquired and implemented new machinery. Now, that's a bit different for banks, right? Banks aren't normally in the business of recording greenhouse gas emissions. Some banks are, starting, especially in the more developed parts of the world, but that's not an easy thing for a bank or FI to do. So, although there can be sources for banks or FIs to obtain concessionary or lower cost funding, it's not without its work, but perhaps that's worth it in the grand scheme of things. Avenue that banks and FIs can look at in Bangladesh to obtain lower cost funding has actually been set up by Bangladesh Bank, and you may well be aware of these already, but Bangladesh Bank has a couple of programs related to providing funding that arguably is at a lower cost than traditional funding. So in this case, a bank in Bangladesh would borrow directly or refinance directly with Bangladesh Bank to obtain lower cost funding. And Bangladesh Bank has said under the Green Refinance Facility that banks can refinance loan they've made to clients denominated in Taka for environmentally friendly products, projects, and initiatives. So if you think about it, all those initiatives to help the RMG sector get to a point where they can continue selling to the EU are environmentally friendly, right? To some extent, environmentally or socially friendly. Is it possible that those loans could be refinanced with Bangladesh Bank? Certainly. Another program that we're familiar with is Bangladesh Bank's Green Transformation Fund. This program is actually designated for USD refinancings or USD funding. So if you think about imports, the majority of imports still, I think, are denominated in USD. So if there's capital equipment that's coming from overseas and it's being charged in US dollars, then Bangladesh Bank or banks in Bangladesh can obtain funding directly from Bangladesh Bank as long as the capital equipment is used for specific purposes that positively impacts the environment or climate. Again, all of these things that we discussed about the ready-made garment sector, retooling and getting ready to make changes that will allow them to continue to sell into the EU, arguably those are all, the retooling is for the specific purpose of having positive impacts on the climate, right? So here's a quick list of the types of things. This list is updated periodically, and I hope it's not out of date, but I think you'll get an idea, and you'll be able to see that already these sorts of purposes directly correlate to the things that the RMG industry has needed and will continue to need to do, especially to as the EU Green Deal becomes more effective. I know that big picture, the idea is that Bangladesh Bank has a pool of money and they want to encourage lending towards these purposes, so they're prepared under certain conditions to lend money at a lower rate than an FI would otherwise be able to obtain from Bangladesh Bank. At the end of the day, what we want to convey here is that there are options, there are ways to potentially look at lowering your costs, and we're happy to talk to you about digging into those a little bit.
Alliance Risk Advisory and Consultancy from Bangladesh and EU Advisory from Singapore have been collaborating to offer comprehensive sustainable finance services and solutions of international standards, aligned with Bangladesh context to facilitate the financial institutions in Bangladesh. These are some of the services that have been provided from our collaboration.